Good evening, everybody. Welcome to today's session again. As every week, we bring to you Krishak and Krishak's training, and hopefully it has an impact on everybody's knowledge and understanding. So again, today, as usual, 6 p.m. UK time, and the weather here is changing, the daylight time is changing, and we are, as usual, always inspired and excited to learn. So Krishak, a very young gentleman who has in a short span of time excelled in his knowledge and teaching of the skill. And Mahir, one of our co-founders, has multiple times given a testimony to Krishak, and he personally himself is being coached. I'm sure there are others. I know one or two others are now in Krishak's down pipeline of one-to-one sessions. And the whole idea is if you get the fundamentals of trading correct, you understand the Forex fundamentals, it enables you to perform much better when you are trading. So Krishak, I know you're with us. I'm just going to see if I can add you to the spotlight with me for a moment. Add. So Krishak, welcome again this week. I know that you're going to do a recap of the last few sessions. This is session number 4, and the series is of 6 sessions before we go back into the repeat. Just before we start, I know that you were talking about, you're going to talk about the market analysis and so forth today. We have some familiar faces. I have shared the links in the YouTube channels in the social media for people to go back and watch the replay as we progressively develop our knowledge every week. I myself have the same diary every single week that I'm making my notes in. And so it enables me to go back and reflect as well. So without further ado, Krishak, I'm going to let you take over. Like I said, everybody, you'll see him as a young gentleman, but the knowledge he has and the technique he uses to teach is totally unique, because he understands that as learners, we need to know in bite-sized chunks how to implement the knowledge that he's giving us. So over to you, Krishak.
Hello, everybody. Thanks a lot, Shazia. It's always great connecting with everybody and seeing familiar faces who have been with us since session 1. Um, the last session was more on lot size and leverage, if I'm not wrong, Shazia.
Yes, last session we looked at also the bank rates, the federal rates. We also looked at commodities and the positive correlation between them, like gold versus oil and gold and
Mm-hmm.
silver, how they went hand in hand. We talked about Bitcoin, and we had lots of questions around, is Bitcoin comparable to gold, or is it known as digital gold as well? So we covered a lot. We talked about supply and demand as well.
Mm-hmm.
So yes, and if I go right back, yeah, so we have covered over the last sessions that we've done with yourself. We started off with understanding the different markets and how many different markets there are. We moved on to looking at bid price, lot size, pips and points. We looked at base currencies, spreads, and the different types of spreads in the market. And then we moved on to comparing the different entities, the participants in the Forex market, leverage, buying power, trading capital. This is like a test for me, guys. Lot size, supply and demand, and then correlation between US dollar, and then also gold and oil and how it works, the positive correlation, negative correlation, and so forth. So today, I believe,
Amazing.
take us forward now.
Amazing. We did look at a couple of topics. In fact, a lot of topics to go back, and let me know if anybody has doubts in regards to any of those topics that we looked at. I would be happy to go over the topics once again. For anybody who's not understood any particular topic in terms of lot size, leverage, supply, demand, bank rates, feel free to drop them down in the chat box, and I would be happy to sort of do a quick rundown or a review on a particular topic if anybody has any doubts. Moving forward, let us do a quick recap on supply and demand. Before we move on, does anybody have any doubts in regards to any previous topic that we looked at? Who are there with us since session 1, Jet Li, KP, Luisa, any doubts,
Altaf.
folks?
Yeah,
Altaf, any
I've
doubts?
opened the
Caesar?
chat so that everybody can put in, so you should be able to see anything that comes into the chat box.
Hmm. Yeah, I don't see anything for now. Let's give it a minute if there's anything, if anybody would like to drop in something in the chat box.
And while everybody's thinking, just a reminder for everybody that Krishak is also available for one-to-one support, and that will enable you then to move straight into the markets to trade yourself. So if you're interested, get in touch with us. Everybody knows how to get hold of me, I'm sure, and we can arrange that. We can get onto a call with Krishak. He can answer any questions, and we can take you forward. The whole idea is this series of webinars that lead you into the one-to-ones, like Mr. Mahir, our co-founder, is now trading, and he had very little trading knowledge. And Krishak, you might want to talk about that, just to enable our audience of where he started and where he is today on his trading journey.
Of course, Altaf, I'll just take this comment. Altaf says understandable, no questions asked. Thank you so much, Altaf, for the comment. So with Mr. Maher, it was more of we got connected, and he was a complete beginner in the markets, where of course he did have a little bit of a knowledge, but that's where I helped him. We sort of figured out a way to understand the markets together, in a way where now he's trading the Forex markets profitably by himself, sending me chart analysis. I'm sending my chart analysis to him for each and every currency pair, what he is looking at. And we are sort of, going hand in hand. It's a hands-on experience that we usually do, where I'm available through WhatsApp or through email, so on and so forth, where you can reach out to me anytime, and we can sort of get started with Forex, and sort of make you a profitable trader step by step, looking at each and every topic. And Mr. Maher is definitely sitting at a point where he's able to make his trading decisions independently. And I'm very happy that whenever he sends me a chart, I'm happy to look at and the way he's been analyzing.
Also, Krishak, last week you gave some homework, which was to compare prices of gold, oil, and USD. So I don't know if anyone's done anyone's actually done that. I've just seen the
Hmm.
homework now. So it shows I'm not the best student, but I do have it written down.
That's fine. That's completely fine. So yeah, any doubts? I don't see any doubts. I think everything's okay, understandable, no questions. It is okay. Thanks for the comment, Altaf. All right, we can move ahead. It's gonna be a quick recap before we move ahead, folks. Uh, we spoke about supply demand. Let's first look at what supply is. What is supply? I hope everybody can see my screen, just to confirm. Okay, perfect. What is supply? Supply is for the sellers, where there's a lot of selling pressure, coming into the markets.
Now we can't see a screen right now. Before we could.
Oops, sorry, just a second. Is it visible right now, Shazia? Is it okay? No,
No, we can't see it right now. No, sorry.
let me stop presenting actually. Stop, stop share, just a second.
Now it's beginning to share. Perfect.
Okay,
Thank you.
perfect. Okay. Uh, supply is for the sellers, selling pressure. Demand is for the buyers. Uh, Buyers are always attracted to a discounted or to a lower price. Let's call it as discounted price. So where does the demand sit? Let's say if I draw a box like this, and this is where the price is coming down to, the price comes down, goes back up, comes down, goes back up, comes down. When such a phenomena happens multiple times, this is called a demand zone. This is where the price comes back down, forms a support. Demand zone is also called a support level, and price goes up. Whereas a supply zone is price goes up, comes down, goes up, comes down, goes up, comes down, so on and so forth. This is called as supply zone, also called as resistance level, and the selling usually happens from here. Now, this is actually something that I wanted to look at in this session is never try to predict the tops and the bottom in the market. It can be any market. It can be any market that you're trading, folks. Never try to predict the tops and the bottoms because most of the money lost is always in predicting the tops and the bottoms. Who knew Bitcoin could go all the way till $125,000? Who knew gold could skyrocket to $4,400 an ounce? Who knew S&P could be as close to $7,000? Nobody really knew about this, right? That is why everybody says never predict the tops and the bottoms because the top could be $10,000 for S&P 500. The top could also be $200,000 for Bitcoin. We never know. The money is always made in riding the trend. And this is the whole topic about today's session is trend is your friend until it bends. Meaning, always ride the trend until you see a sign of trend changing or the direction of the markets changing. This is what we're going to look at in today's session in identifying how a trend is formed. What is a trend? How many types of trends are there? How to identify a trend? How to identify a change in trend? This will help you to understand as to when a trend is formed in a certain direction. How do you ride the whole trend? If the trend changes, how can you ride the second trend going down as well, which is called short selling? All right, this is supply and demand, and we'll do a little bit of a correlation as well. This is going to be a quick correlation. USD goes up, gold goes down, uh, oil goes up, USD down, oil up, gold up, oil up, gold up. The reason why is this is because of positive correlation, because of course both of these are commodities. That's why um, oil and gold go up hand in hand. What is USD called as? USD called as the dominant currency. Oil is nothing but the world economy. Gold is known as safe haven. This is how we usually classify different assets. Talking about crypto, if anybody's into crypto, if anybody wants to know about what crypto is called, Bitcoin is also called digital gold or king of cryptocurrency. This is also what it is. If the bank rate, let's talk about the bank rate. Let's talk about the US federal rate. The US federal rate is sitting at 4%. The US federal rate as of now is sitting at 4%, meaning US dollar is weakening right now. Stocks are strengthening because of high buying power. Since the rates are lower, the US bank rates are lower, the debt is increasing in the US because of lower interest rates. This is why the USD is decreasing as of now. But there was another news event. There was a fundamental news event in regards to US dollar 2 days ago, which spoke about jobs in the US, right? Jobs in the US increased by 42,000, and pay was also increased by 5.1%, which drove the US dollar, which technically the US dollar increased in value when the news came out for the jobs and the annual pay being increased by 5.1%. Pay is nothing but the salaries being increased by 5.1%. This actually drove the market. This did bring a lot of supply in, this did bring a lot of demand into the markets. So US dollar went up and stocks started to go down. This is what has happened for the past two. So this is the recent news. This came out 2 days ago, and this is what the market is reacting to right now. So if anybody is sort of not sure what's happening to the stocks, let's look at S&P 500. The reason why the stocks are falling is because of the news that came out 2 to 3 days ago. That's why the stocks are tumbling. If you look at the dollar index, this is the dollar index. The dollar index rose in value by 1.7, 1.8%. It's technically been falling since the beginning of the year, but it is sort of starting to recover from 96. It touched 100 and now it's back to 99.7. What is DXY? And DXY is nothing but US dollar index. This gives you an idea of the economy of the US economy, how it's performing, is the economy strengthening, if the economy is weakening. So this particular chart or the index, which is known as the DXY, the US dollar index, gives you an idea of how the US economy is performing. Back to our topic. Today's topic, I hope there's no doubts before we move ahead. I hope everything's clear with regards to bank rate, funds rate, supply, demand, so on and so forth, correlation as well. All right. Let me open the chat box. I see two chat box. Okay, it is clear. Was clear also. Thank you, Altaf. We can move ahead. Okay. Let's talk about something, a new topic today called as trends. As I mentioned before, trends is nothing but trend is your friend until it bends. I have been following this for the past 6 to 7 years, and this is what set me apart from 95% of the people losing money in the markets. The reason why is I always go what the trend is doing or what the trend is saying. I never predict the tops and the bottoms. What is a trend? Trend is nothing but the direction of an asset, right? It is a method of determining or predicting the direction of a particular asset. This is a trend. Can a trend move in a straight line? A trend never moves in a straight line. It never moves in a straight line. Have you ever seen a trend move like this? Ever seen a trend move like this? No. How does a trend move? Up, down, up, down, up, down, up. This is how a trend moves, right? If you want to reach from point A to point B, do you always go straight? Do you go straight? No, you go straight, you go left, you go right, you take a U-turn, you park your car, you get out of your car, and then you reach the destination where you want to go. It's the same thing with trends. A trend never moves in a straight line. A trend can move up, it can move sideways, it can push up, it can go down, start moving sideways again, keep pushing down, go up. It can do whatsoever. And this is what we are here to understand as to how do we predict these market movements. Trend never moves in a straight line. That's correct. How does a trend move? It moves in waves. Trend makes waves known as impulse and corrective waves. Let me take the line off. Okay. Trend makes waves known as impulse and corrective wave, meaning impulse wave is the main direction of the trend, whereas the corrective wave is the against the main direction. That is why it is known as a corrective wave, shorter than the impulse. Shorter than the impulse wave. The main direction of the wave is always the longer wave. It's always the longer wave, right? And when you look at a trend, when you look at a particular trend, the long wave here, this is known as an impulse wave. The long wave is known as the impulse wave. The shorter wave is known as the corrective wave. Then we have another impulse wave forming, the long wave again, impulse, corrective, so on and so forth. So this wave, this particular wave that you see here, the short wave that you see here that I'm highlighting right now, this is the corrective wave. The wave that I'm highlighting right now is the impulse wave. This is the impulse wave. Impulse wave is always longer than the corrective wave. If the impulse wave becomes longer than the corrective wave, this is when a change in trend happens, and this is what we're also going to look at as we move ahead. Uh, this is an uptrend. This is how an uptrend is formed. When we look at a downtrend, this is impulse. When the markets are going down, the longer wave will always be the wave that's going down. So this is the impulse. This is a corrective, impulse, corrective, impulse. This is how it is. You will never see a trend move in straight line, as I mentioned. It always forms an impulse and a corrective wave. So always make sure that when you're trading, when you're investing, never try to predict the tops and the bottoms. And I'm going to keep repeating because this is where people make the mistake. This is where most of them make the mistake, saying that they want to buy at the cheapest rate possible. Everybody leaves some money on the table. I myself leave some money on the table when we book profits, right? If I bought an asset, if let's say, for example, if I'm buying an asset at $100 and if it goes to $250, I made $150. This is my profit, right? But if it goes above $250, if it goes to $300, I'm missing out on 50% of the profit. But I'm out of the market already. I'm out of the market at $250, right? But the market went up to $300. Am I missing out on this? I am missing out on this. Am I leaving the money on the table? I am leaving the money on the table. Am I okay to leave money on the table? I am okay because I have secured the profit that I was targeting for. Never be greedy in the market. Secure the profit that you have targeted. Be willing to take the loss that you're okay to risk. Risk in the market is something that we can control. Profit target is something that we cannot control in the market. So when you're placing trades, make sure that your risk is only how much you are willing to lose, not something that you get. Let's say if you're willing to lose, or let's say if you're risking $100, make sure you're okay to lose those $100 and not risk more than $100. Right? Because if you lose more than $100, that's when your emotions kick in. That's when you say, no, I plan to lose $100. Now I lost $200. You want to make that money back. That's when revenge trading comes in the markets. You start to revenge trade. When you revenge trade, you are betting against the markets. When you bet against the markets, you lose more, 200, 300, 400, 500. And then by the time you realize you're down 50% of your account, you've lost 50% of your capital from $1,000, you're down to $500 now. It all starts from one small thing, that is abiding by how much you're willing to lose. If you're willing to lose $100, be okay to lose only $100 and not more than $100. And this is the first step of your risk management journey. Also, and also not in predicting the tops and the bottoms. The real money is made in between the market, in between the trend. This is where the real money is made here. I hope this is clear. Any doubts with impulse and corrective wave? We can move ahead. Let's look at classification of trends. Let's look at classification of trends. There are three kinds of trends. Uptrend. A lot of people only think that no, there are only two types of trends. The market only moves two ways, up and down. No, there are three kinds of trends. One is uptrend, downtrend, and the third is consolidation, also called as sideways market. The market will not always go up, will not always go down. But when there is no volume, when there's a big news event coming in, like interest rates, or if earnings is coming out for a particular company, the markets are going to go in a consolidation phase where you will see the markets are moving sideways. Means there are 10 buyers, there are 10 sellers trying to sort of say that the buyers push the market up, the sellers come and push the market down. As the buyers are more than sellers, that's when the trend changes from a consolidation phase to an uptrend. Let's look what an uptrend is. When you look at an uptrend, price makes something called as higher highs, HH, and higher lows, we call it HLs. Price will always make higher highs and higher lows in an uptrend. Now, when you're looking at an uptrend, the candle, I'm going to write everything down and then come back, explain each and every point. The candle has to respect the previous low to continue up. And what is your previous low? Your previous low is going to be the higher low, which is nothing but your support level. Look for buys only. As I mentioned, trend is your friend until it bends. Follow the direction of the main trend, never go against the direction of the main trend. Let's look at how an uptrend is formed. Impulse, corrective, impulse, corrective, impulse. We looked at supply and demand in the previous session. When we looked at supply and demand, we spoke about supply being for sellers, known as resistance. Demand is a level for buyers, known as a support level. We're going to use this concept in identifying a trend or identifying higher highs and higher lows. This point right here that you see up top, let me bring my circle. I'm going to mark this as a red circle. This circle that you see here, this is known as a supply zone, correct? Because this is a resistance. This is known as a supply zone. Supply zone is nothing but higher high, a resistance level. What is a higher high? A higher high is a resistance level in an uptrend. A higher low is a support level in an uptrend. So this is a resistance, this is a supply level, this is where the price falls. It comes back down, forms support, meaning it forms demand. Demand is trying to increase and the price goes up. So if demand is increasing from this point, what is this level called as HL, higher low, known as your support level. This is where the price goes up from. The price breaks the previous higher high, breaks the resistance. As it breaks the resistance, where does it go to? It goes up to form a new resistance, and the new resistance is called a higher high again. Why is it called a higher high? Because this new resistance that it has formed is higher than the previous high. Is it clear? This new resistance that it has formed is higher than the previous high. So this is a higher high. It moves up, a new higher high is created. So every time as the market goes up, a new higher high is always created. And as the market comes down, a new higher low is always created. Why is it called a higher low? Because this higher low is higher than the previous low. Support level is a low point, correct? Support level is nothing but a low point. So this higher low is lower than the previous. Sorry, this higher low is higher than the previous higher low, right? So when you look at the markets, if the markets are moving like this, it is very easy to mark higher highs, higher lows in an uptrend. Now, your question might be, where would you buy? Your buying opportunities are always at higher lows and never at higher highs, because higher high is a level of supply, is a level of resistance. That is where the sellers are active. You always would like to buy at a higher low, which is a buying price, which is a buying level, also known as a demand zone. This is where you would like to buy. Let me give you an example. Let me give you a beautiful example of gold. Or let's look at gold. When gold was going up, I'm gonna draw higher highs and higher lows in this chart. Okay. When gold was going up, let's take this chart here. Uh, price price made a high. This is a higher high. It made a higher low. It made a higher high. It made a higher low. Please follow my cursor. So you will see how higher highs and higher lows are being created in the markets. Higher high is being created. Higher low creates. A new higher high is created. Higher low. Higher high. Higher low. Higher high. Higher low. Higher high. This is how higher highs and higher lows are created. What do you see in common? Each and every higher high that is being created is breaking the previous higher high. This higher high up above broke the previous higher high. This higher high broke the previous higher high. This higher high broke the previous one, so on and so forth. And what's happening to the higher low, the support level? Higher lows are being respected, meaning does this higher low break the previous higher low? No. Does this higher low break the previous higher low? No. Does this higher low break the previous one? No. Does this break the previous one? Does this break the previous one? No. Each and every higher lows are being respected. This is how an uptrend is formed, meaning you're following the trend. And how does a trend change in trend happen? Did you notice any of the high lows being broken here? No. None of the high lows are being broken. Am I correct? Each and every higher lows are being respected. This higher low broke. The price broke the higher low right here. I'm gonna draw a box. Let's say the box is golden in color. Okay, let me make it a bit white. Okay, this box right here. This higher low broke and the trend started to move down or sideways, right? This is where a change in trend happens. Can I say that a change in trend is going to happen from here? No. Can I say a change in trend is going to happen from here? No. When does it happen? from this particular scenario, from this point in here. Not from here, not from the middle, from here. That is why never predict the tops, never predict the bottoms. The real money is made in the middle of the trend, in between the trends, never in predicting the tops and the bottoms. If somebody would have bought it here, if somebody would have bought it at higher high, they would have lost money. If I would have bought it at the highest point in price, I would have definitely lost money, right? Did I know that the markets are going to fall? No. If anybody who knew the markets are going to form this way or go in a certain manner, everybody would have been a millionaire or a billionaire by now, and the success ratio would have been 100%. There would be zero failures in trading or an investment industry. Everybody would be making money by now. So the real reason or the real way to make money is repeating it again. Never try to predict the tops and the bottoms. Go with the direction of the market, see how the market moves, and follow the main direction. Follow the impulse wave, wait for the correction to be formed, then ride the second or the third or the fourth impulse wave. The markets are not going anywhere. The markets are going to be here tomorrow, day after a week, after a year, after 10 years. Make sure to manage risk properly. Risk management is very important because if you lose $1,000, you will have to deposit $1,000, but the markets are not going anywhere. Your money is going to go, you're going to lose money, right? So make sure that you manage risk, you buy, you sell. That's a very important concept. Let's move on. Let's move ahead. I hope uptrend is clear. Any doubts with uptrend? I see a comment. I see something on the chat box. How to check trend line on candle time, 5 minute, 15, 30, or 1 hour best time? Very good question, Mr. Mohammed. To check the trend is always identified on the higher time frame. And your higher time frame are gonna be 1 hour. It's gonna be 1 week, 1 day, 4 hours. These are gonna be your higher time frames. We call them HTF. Because when you look at a lower time frame, you'll see multiple changes in trend. The trend can go up, down, so on and so forth. You can see the trend changes every 5 minutes. If you look at the 5 minute chart, the trend changes every half an hour because each and every candle is for 5 minutes. If you look at an hour, the trend changes every 6 hours because that's how the candles form. But if you look at a daily, weekly, or the 4 hours chart, each and every candle takes its own time to close, right? If you look at the daily candle is open in FX, it's open 24 hours, right? So it takes its own time to close. The chart that we are analyzing right now, the chart that we analyze right now is on the 4 hours. We looked at the 4 hours chart. If you look at the 15 minutes chart, you will see how the trend is changing, right? It goes up, higher high, higher low, higher high, changes down, goes up again, moves sideways. The lower the time frame you go, the lower the confirmation as well, the weaker the confirmation. I'll write this down for you so you can take notes. Higher the time frame, stronger the confirmation, lower the time frame, weaker the confirmation, right? Because when the higher the time frame you go, the candle takes its own time to close. The lower you go, the candle is in need to close. It's like, yeah, the candle has to close in 5 minutes, right? So the candle can just go up and down, and then close. However, as the time stops in 5 minutes. But higher the time frame, stronger the confirmation. I always like to analyze trends on the daily and the 4 hours. I hope this answers your question, Mr. Mohammed. Thank you. If I put trade if trend change, so please guide what my SL. Your stop loss should always be below the support level. If you're buying here, if you're buying anywhere here, let me go back to the chart. It's a very good question. If you're buying anywhere at this level, at a support level, your stop loss should always be below the support level and not in between, because this is where the price went up from. So that there is a possibility the price can come back down, form support, and then go back. So the support level should always be below the wicks. This is where it should be, below the wicks. Not exactly below, but give it a little bit of a buffer space, a few points below the wicks. If you're buying, if you're selling, a few points above the wicks. Stop loss placement should always be below or above the wicks, depending on the direction you're buying or selling. All right, we can move ahead. This is in regards to uptrend. I hope everything's clear. Let's look at what a downtrend is. Price makes lower lows, called as LL in short form, and lower highs, called as LH in short form. What is LL? LL is nothing but your support level. LH is your resistance level. Price makes lower lows and lower highs in a downtrend. Candle has to respect the previous high. When we were looking at an uptrend, the candle had to respect the previous low. In a downtrend, the candle has to respect the previous high to continue down. Always look for sells. Never look for a buying opportunity. Sells is nothing but short selling in the market. This is what short selling is. I think we did touch upon what short selling is. Selling at a higher price and buying it back at a lower price. This is short selling. Let's see how a downtrend is formed. Impulse, corrective, impulse, corrective, impulse. Let me decrease the size. It's a bit too big. Okay, never mind. It's okay. Okay. Let's bring this into the spotlight. LL means support level. Support level is nothing but a demand zone. This is a support level. Why is this a support level? The price is going up from here. That is why it's a support level. So this becomes your lower low in a downtrend. Let me get my text. Lower low. This right here is your lower high. Why is it called a lower high? This is a resistance level or a supply zone. This is where the price is falling from. This is where the price is falling from. This is a lower low. Why is this called a lower low again? Support level. This low is lower than the previous low. That is why it's called a lower low. And then we have lower high. Why is it called a lower high? This high is lower than the previous high. That is why it's called a lower high. In an uptrend, it's called higher highs and higher lows. In a downtrend, lower lows, lower highs. I hope this is clear. The candle has to respect the previous high, meaning if this high is formed, this high has to respect the previous high for the price to continue keep pushing down. But let's say if a new high is created into the market, if it breaks this lower high, if it breaks, then the trend changes, right? Then the trend changes. But if it does not break and it keeps pushing down, the trend is still bearish. It is still a downtrend. Let me get rid of this. It is still a downtrend. So in a downtrend, the trend has to respect the previous lower high to keep pushing down. If it breaks, a change in trend is possible. Is it sure? Nothing is sure in trading. Nothing is sure in trading. But the probability for a trend to change is much, much, much higher. Let's look at a few examples. Let's go back to the chart. Anybody, feel free to drop down your suggestions as well if you want me to look at any chart and form higher highs and higher lows in any of the chart, in any of the asset. Anybody who would want me to look at any particular chart, Tesla, Euro USD, FX, crypto, commodities. Anybody? 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 Nobody?
Nobody said anything yet.
Let's give it a few seconds. All right, let's move ahead. Let's let's look at S&P 500 since everybody knows what S&P 500 is and how it's been performing. Let's look at a downtrend opportunity in S&P 500. Now we're going to focus on this is S&P 500. We are again looking at a 4-hour chart, a higher time frame chart. We are going to identify a downtrend. Lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. A new lower low is not being formed. It's the first indication of a change in trend. A lower low is not being formed. This is the first indication of a change in trend. As the lower high breaks, a change in trend happens from a downtrend to an uptrend, and the charts keep going up. Mr. Mohammed is asking, is S&P crypto or FX? S&P is an index. It's the full form of S&P is Standard and Poor's 500. It measures the performance of the top 500 companies in the US. It falls under the stock exchange. It is not under crypto or FX. It falls under the stock exchange. It's an index. It is a view-only index. The reason why it's view-only is because it tracks the performance of the top 500 companies in the US. Tesla, Nvidia, Meta, Apple, so on and so forth. Whatever you can think of, all the top 500 companies, this is what it tracks. Let me label it. This is lower low. This is lower high. Lower low again, lower high, lower high, lower high, lower low, lower low, lower low, lower high. This is the point, as we discussed, when a lower high has been broken, the price does not respect the lower high. A change in trend happens. This is the point. So were we able to sort of predict the tops and the bottoms? No. When did we understand that a change in trend happened? When it broke the lower high in a downtrend, changed to an uptrend. That's when it switched to an uptrend. I hope this concept is clear. Thank you so much, Mr. Mohammed, for the comment. Any doubts? If not, we can move on to consolidation. I don't see any comments in the chat box. All right, let's move on. Consolidation or sideways? What is consolidation or sideways? Consolidation or sideways is one of the markets that everybody should avoid trading, is because the markets are volatile. What do you mean by volatile? Price fluctuation. The markets are volatile, which means if buyers push the price up, sellers will push the price down to the same level where it went up from. Push the price up, comes back down, up, down, so on and so forth. This is the market that I avoid trading. When something like this happens, I'm away from the screen because this is a messy range. We call it a messy range, right? You buy it here, yes, you can make a little bit of a money. You sell it here, you can make a little bit of money. But then one wrong move, all your profits are gone because then the move is extremely sharp. It falls extremely or it goes up in a very sharp manner. So consolidation is something that everybody should avoid to trade. No need to trade consolidation. Uh, it's also one of the ways to save your money, right? You're not making anything, but you're also not losing anything. So you can use that money to sort of trade when the markets are giving you a clear indication. Consolidation is nothing but sellers are in, buyers and sellers are equal, or we call it buyers and sellers are in equilibrium, means there are 100 buyers, there are going to be 100 sellers at the top, at the supply zone, who push the price down. So these are the markets that we should definitely avoid to trade. Um, Let me give you an example for this. Let's look at gold. Gold currently, yes, gold did have its sweet upside, did touch $4,400 per ounce. It was rallying quite a bit actually. But now what's happened to gold? Buyers are pushing the price up. This is where the buyers are pushing the price up from. This is where the buyers are pushing the price up from, pushing the price up, and the sellers are pushing the price down from here. This is consolidation. So what do you see? What's happening? The price is moving in between the bands of supply and demand, right? In this scenario, always better to avoid trading because you don't want to lose your money. It's okay if you don't make money, but you're not losing your money. So this is one point where you want to avoid the markets. Not confirmation where the markets are going. Correct. This says that the markets are sort of waiting for either the buyers to take over or either the sellers to take over. So keep your hands in the pocket, do not trade. This is the best I could say. Not to place any buy or sell positions when the markets are going sideways. Well, I think we are almost out of time, Shazia. We can take up
Yeah,
the
we can take some questions. I
questions.
think, how do people find it? Let me see if you can all mute. You should be able to
Please,
mute yourself, guys. If you want to, you can. It's clicked. Unmute yourself. If you have a question, please kindly unmute yourself or pop it in the chat box. Any comment. It doesn't have to be a question. It could just be something that I have understood for the first time is how to actually read the trends and what an upward, downward, and a consolidation trend is, with the real example of the markets. Somebody else might have an observation that they'd like to share. Thank you, Krishak. Just waiting.
I'll just take this comment, Shazia. It's Mr. Mohammed has said, please recommend uh, best backtesting software. Um, Backtesting is good, but I would suggest go with forward testing. The reason why is you already know what has happened in the past, right? So even if you try to backtest from here, trying to predict support and resistance, you already know where the price has moved. In fact, try to predict where the price is going to move now, right? Because if we say, okay, I'm gonna backtest this, I'm gonna say that this is a support level because this is where the price is going, pushing up. I'm looking at looking at what has happened next after forming support, the price went up. So I already know that. So I'm not back testing. I already know that yes, the price has moved up. Rather, come to the real markets, look what's happening live in the markets right now. try to make predictions based on that. This is how you're going to improve your trading, right? Predicting the live markets, not backtesting. Backtesting is like, yeah, you can backtest. Backtesting is good. Backtesting is not bad. But you already know that the move has already happened. So you know that support has formed, it's going to go up. But what's going to happen from here, you don't know because the price has not moved yet. So it's always good to forward test, meaning try to predict the next move, either up or down after what the candles do. I hope that answers your question, Mr. Mohammed.
It says, I've got here from Dr. K, love what you said, Krish. Keep your hands on your pockets when it's a consolidation sideways. Agree 100%.
Thanks a lot. Thanks a lot, Dr. KP.
Any further comments? Any questions? We're bang on time, 7 o'clock. Thank you so much. Thank you, Mohammed. Louisa has put, do the price media depend on supply and demand?
Did the price media or price action, Louisa? Would you like to unmute yourself? Is it price media or price action?
Probably price action. I think she's, are you, Louisa, Spanish speaking? Maybe she's translating, possibly. So I
Price
think
action. Okay.
price action, yes.
No worries. Price action. Do the price action depend on supply and demand? Yes. Price action is 100% on supply and demand because what we are doing right now, supply, what's happening? Supply, price is moving up. So price is making an action. What is price action? Price is doing some sort of an action. It's moving up or down or sideways. That is price action. So price action and supply and demand are 100% interlinked. Because if price is moving off of from a certain level, that means there is a lot of demand coming in from this level. If it's going down, there's a lot of supply coming in from this level, right? So yes, price action, supply and demand are linked. Thank you, Louisa, for your question. It was a great question.
Well, I can't see any more questions. I can see lots of thank yous and appreciation. Jet Li saying thank you, another great session. Mohammed saying thank you so much, great job. So I'm assuming everybody has enjoyed the session, have enhanced their understanding of the trends and have a better understanding of the different types of trends. My favorite comment was the revenge trading. When you talked about don't look at the tops and the bottoms. I think that was quite powerful. And the real money is made in between the trends. So
That's
I'm going to
correct.
take that away. So thank you, Krishak, again for a phenomenal session. Thank you, everybody, for joining. I'm conscious of time. We really like to value you all again over the social platforms, through your leaders as well. You'll find the links to our sessions that are recorded. They are in English. We do get them translated into Spanish. They are also available on the Qminds YouTube channel, but also the MyQFX, where you can see all the daily analysis taking place too. So thank you, everybody. Once again, Krishak, Nagar, thank you very much for your time. And we shall see you all, same place, next week for our fifth
Thanks a
session
lot.
of the sixth. Again, anybody
Thanks a lot, everybody.
interested in a one-to-one session, please get in touch. You know, it's not an obligation that you get in touch and you have to start. It's an opportunity for you to understand, get yourself assessed, identify where you are and then where you could possibly be. And maybe you could be a killer trader in 2026. So thank you all and look forward to seeing you again next week. Final comment. Let me just quickly scroll down. Everybody's saying thank you. Thank you, everybody. Good night from where
Thanks. Good
I am,
night. Bye-bye.
and good afternoon wherever you are.